I also want to welcome you on behalf of our collaborator, Polaris Bank. On behalf of the management and staff of Polaris Bank who are in this, again, I want to welcome you to, this is our second in the series of our tax webinar. The first one was held on 30th of June 2020, sorry. And the theme for that was the new phase of tax practice and compliance during and after COVID-19 era. That webinar 2 was a huge success. Without sounding immodest, we had over 500 people that signed in, and it was highly interactive, and the feedback we got was very impressive. Now, most of the questions too from the feedback bordered on VAT and stamp duties. You know, people were asking a lot of questions. Of course, we are aware that increased the VAT rate for Nigeria from 5% to 7.5%. So there was a lot of worry and concerns. And then not long ago, government also spiked up the issue of stamp duties, collecting stamp duties from bank transfers, any bank transfers, and even tenancy agreements. So it raised a lot of concern by the people. People are complaining, believing that they are taxed, you know, considering the situation we found ourselves in. You know, but government also believes that they need this money to be able to meet their obligations. So we decided that we should have yet another conversation on issue of these taxes. There's this feeling and belief that the people are overtaxed. In fact, somebody used the word that the government is an overdrive tax. So we said, okay, we need to have this conversation to explain to the people about the VAT stamp duties. In fact, we actually have somebody, one of the speakers, Femi Olarinde, is from the office of the FIRS, Federal Inland Revenue Service. So he's going to give us his perspective from the government and explain out issues that people will want to understand about the new VAT and most importantly, the stamp duties. So Femi will be here, will be speaking to us. But we decided to take another perspective or a different perspective to our webinar by bringing in an international speaker who will serve as like a keynote speaker to look at the effect of aggressive taxation on a fragile economy like Nigeria. And we went all the way to UK to get our friend and a tax using Nigerian language to talk effects drive in a developing economy, a panacea for economic growth or economic harm. Is using tax practitioner is also a popular, and the first speaker will invite to give us his experience, his perspective of how aggressive tax drive by the Nigerian government, how he thinks is going to affect our fragile economy. Now, when Tony is done, we'll invite, that is what Dr. Jerome is going to speak on. And then after Dr. Jerome, we'll have Olumide Obayemi. Olumide Obayemi is a lecturer in the University of Lagos. After Obayemi will speak on stamp duties and VAT regime. He will speak on challenges of collection of VAT on other sales of digital products and services under the Finance Act of 2019. And then finally, we'll have a big man from FIRS, Femi, who will speak on stamp duties regime in Nigeria, matters arising. A whole lot of matters definitely to be addressed by Femi Olarinde. but he's here to calm us down, give us the government perspective, and explain things out to us. So I wouldn't want to take so much of it. I would want to invite the speakers to speak. Your questions ready and send them in. Each speakers will speak for 20 minutes. Then after that, we go into the question and answer session. So at this point, it's 1:16 p.m. Nigerian time, and I want to invite Tony Gimple to talk to us. Again, let me welcome all participants. I noticed that some people signed in from Brazil. Victor is from Brazil. Yusuf is from Kaduna, and then Castana State too is here. Welcome everybody, and Tony, please, you have the floor.
Thank you very much.
Time starts to run now, and you have 20 minutes to talk to us.
I'm sure I can do it quicker than that. But thank you very much for hosting this. It's been a long time since I was in Nigeria, which was in the late 70s. I was up in Kano.
Okay.
Yep. Very different world then, but some things never change. So without further ado, let me start sharing my screen, and we'll go on to one there. So what I want to do today is give you an overview, on whether or not aggressive tax drives in developing economies are a panacea for economic growth or a real cause of economic harm. I'm going to take this at a fairly general level. So let's take the overview. All governments, regardless of whether in the world, local, federal, national, we've got real challenges. COVID-19 is just one, and that's the whole problem of taxation into dramatic relief. All nation states, from principalities such as Monaco, plus USA, Russia, and even the failed states of Afghanistan, Lebanon, and Sudan, they have to raise taxation, and you might say it's state predation in many ways. The corrupt or crony corralling of resources, and in places, unfortunately, goes on. But regardless of the legitimacy of the state protection racket, it has to do its job. And the blunt instrument of taxation is about the only way that even the thinnest veneer of respectability and self-perpetuation can be maintained, regardless of whether it's good for the citizens or not. So moving on from that, is taxation new? No, it's been around since man himself. And the first recorded episode of taxation was in Egypt, some 1,000 years BC. Getting some feedback here, so stop in a second. And in essence, it was a way that the state could extract labour as opposed to money from those too poor to pay tax. In fact, labour in ancient Egyptian is a synonym for taxes. So not a lot has changed in that regard. It is even mentioned in Genesis, but when the crop comes in, give a bit of, well, nothing new. Nothing ever changes in society. And whoever controls has to, in order to stay in control. Well, again, taxes on consumption, and this is where we start to get into the ancient equivalent of VAT. Julius Caesar himself had a general sales tax, centesima rerum venalium. So it goes back a hell of a long way. And duties on imported goods always generated, or it's obviously more important, than internal excises. It can produce a lot of you And even back then, there was a balance of payments to wow. If you more than you exported, your economy's in trouble. And a way of balancing that out was through taxation. And when war, property would be imposed. We've got a long history of that, as with a slide's time. Indigenous population, slaves, always different ways of taxing people. Why? Because other than being morally corrupt and bankrupt, it's to have particular relevance to emerging economies. Now, I've done a lot of presentations on this, and here are the principal UK taxes, or as I like to put it, what we have to pay the state protection racket to keep the lights on, police the streets, fight the occasional war, and still have the right to talk about it. Well, the first one of these is value-added tax, although I have no idea where the value is and who gets it. Sure as hell isn't me. Although some people say that having VAT, turnover on business, is a mark that you're doing well. In effect, it's just another way that the government can tax you. Income tax and dividend tax, well, stealing the mud. You've earned money, you've paid tax on it, you've spent money, you've built wealth, you've sold something. Somebody comes up behind you and says, "Can I have 28% of your profits, please?" I'm still trying to work out where the value of that one is. And then stamp duty, land tax. Money for nothing and your chicks for free if you're the Exchequer. Now, if you're buying property in the UK, whatever you're paying to buy the property, if it's not your principal private residence, in the UK, you pay corporation tax at 19%. And instead of being a Robin Hood tax, it is stealing from the rich, give it back to the rich. So it doesn't go very far after that. And then finally, the one I hate more than anything else is inheritance tax. State-sponsored grave robbery. 40% of pretty much everything but £500,000 disappears into the hands of the Exchequer with very few ways of dealing with it. And one of the greatest injustices introduced in the UK was what was called Section 24, the landlord tax, where instead of being taxed on profit, you effectively get taxed on turnover. It has had a dramatic effect on the entire buy-to-let market. So back to the history, it's no wonder that in landlord and tax collector are two of the world's oldest insults. So we all suffer at the hands of that. Growing pains. Well, Nigeria is no different from any other country. We're all human after all. You've got the same problems and opportunities that any other natural resource, rich nation with a young, increasingly educated, sophisticated and demanding population has. It's no different than here in many ways. Global warming, sustainability, falling oil prices, neo-colonialism, as if we hadn't had enough of that, with the PRC trying to buy its way into Africa, political corruption, real or perceived, Islamic fundamentalism has caused all sorts of issues, completely around any means, narrow tax bases, and a relatively static tax to GDP ratio, and an unorganised informal sector, who don't like paying tax and will try to avoid it, all will contribute to the Nigerian federal government's woes. It's inevitable. Plus, you've then inherited the English tax, legal and political system, which was pretty dysfunctional to start with and remains so. as a result of that, it shouldn't come as a surprise to you all that, if you want to raise money for whatever reason, as a tax collecting nation, it's easiest to go for the widest and easiest to collect from base. Inevitably is indirect taxation, consumer taxation, really. So let's have a look at compliance versus avoidance. The higher you raise taxes, the more people will find a way of not paying it. Evasion, not good. It deprives central government and ultimately the populace from a lot of additional services. And if you don't want to pay tax, if the government insists on taxing you on income, a direct system, then it's pretty easy to do, particularly if you have an informal economy who takes payments in cash. But if you're collecting indirect transactional measures, VAT, stamp duty, customs and excise duties, every time something is bought and sold, from shares to bank transactions to property to purchasing a new suit, and the government will dip its beak. It will put its hand in your pocket as far as it can. And then let's have a look at now, is the Nigerian economy strong or weak? When I say perception is reality, but in all likelihood, the Nigerian economy is far less fragile than its apparent dependence on oil revenue would suggest. You've got a young, dynamic, entrepreneurial culture, and oil only accounts for 9% of GDP, albeit best part of 40% of tax revenue. Now that will change as oil goes out of fashion. But if the government can focus on agriculture, digital, entertainment sectors, and find ways of encouraging the informal economy to apply and making life simple, then actually tax revenue will cease to be an issue. And in fact, the lower the headline rates of tax, the more the Treasury, the Exchequer will collect, because people don't mind paying it. 20p in the pound is fine. 60p in the pound? Yeah. Or in previous eras in the UK, at one point it was 98 pence in the pound. Why bother? You might as well stay at home and do nothing. So let's have a look and have a bit of a summary now. And I've kept the presentation deliberately short just to give you a high-level overview. The Nigerian FRS, simply like any other Treasury Exchequer, simply wants taxpayers to pay the correct amount of tax. The question is, but here and there, is the correct amount? So I'm a great one for standing on the shoulders of giants and using other people's sayings, but there's an Indian one that I really like. It goes along the lines of, the tax and legal system is like a cow, and that to keep it healthy, one must milk it every day. Well, for fear of mixing my metaphors and to avoid being kicked in a painful place, it's best to do the milking with soft hands and a straight back. That way, everyone works within the rules and complies and can live with it. So, if the Nigerian government and other emerging nations, want to encourage good dairying cricketing practices, well, then Nigeria could be a role model, a massive force for good, a Pan-African role model, a real economic powerhouse. And as much as some people will try and deny it, Africa gave rise to us all. So there's no reason why it shouldn't lead us and give rise to a new era, into the 21st century and beyond. So my conclusion, and then I can hand over to people who know far more about it than I do. So back to that original question: are aggressive tax drives in developing economies a panacea for economic growth, or a cause of economic harm? Let me know when you find out the answer, but only time will tell. But the only thing that I know is that if we want the state protection racket to deliver most when it's needed most, like an insurance policy, for example, in response to COVID-19, or to develop education and entrepreneurship, then whilst every sane man will complain about the tax man sticking his hand ever deeper in our pockets, over time, a well-funded, diligent and honest public sector will bring about economic growth. Albeit it's far from the panacea, some will inevitably make it out. But overall, we have to pay tax. It's the price of the modern world. And I said at the beginning, if we want the street lights on, if we want what passes for a broadly civilized society, where the state can help us when we can't, not won't, look after ourselves, then it really is in everybody's interests to play by the rules of cricket, pay their fair share, and make everyone a success. Right, that's my diatribe done for the day. So, are there any questions before we hand back to the other experts?
All right, thank you so much, Tony, for that presentation. You did it well, almost like 20 minutes, so thank you so much. Your questions will come, or rather we'll take the questions at the end, okay? So you just be on standby and listen to the other speakers, and then at the end of the day, we'll take the questions together. I pick up something from what you just said. Indirect tax is the widest and easiest way to collect taxes, and Nigerian government, like most governments, will want to go for that. But your conclusion is that it is best to do the milking using the cow, the Indian story, soft hands, and the straight bait. So, using the Nigerian language, or Nigerian term, government should take it easy, jeje, with the citizens. I think I want to summarize your presentation that way. Thank you so much, Tony. During the question and answer session, I'm sure you also elaborate further. Okay.
Yeah, my pleasure. Thank you, sir.
Yeah. At this stage, I want to invite our own Dr. Jerome Okoro. Yeah, for those that are asking, the slides will be shared at the end of this program. We'll have all the slides from the presenters, so we'll share them to all the participants so that you'll be able to get it. Meanwhile, this program is being streamed live on Facebook and also on YouTube. Okay. Dr. Jerome, are you ready for us? You are the next speaker, and you are going to talk to us on your mic is muted, Dr. Jerome. Please unmute your mic and put on your video so that our participants will be able to see you. Dr. Jerome. You. Okay, maybe what we'll do, we'll move to, so that Dr. Jerome, I'm sure he's having some technical issues and all that. Can we, Mr. Bayami, can you talk to us? Are you ready to talk to us?
Okay.
By the time you are done, I'm sure Dr. Jiro will be able to get himself together.
Okay. What about Mr. Philip? Can you put on the slides? Good afternoon, everybody. Okay, so we are going to talk about.
Olumide is talking to us on challenges of collection of VAT on cross-border sales of digital products and services under the Finance Act 2019. Like I mentioned earlier, Olumide is a lecturer, senior lecturer in University of Lagos, and he's a seasoned tax man in terms of knowledge. Okay, Dr. Jerome, are you ready? Dr. Jerome, are you ready?
I'm here now. I'm so sorry.
Okay, so are you ready to talk to us?
Oh, yes, yes.
Okay, fine. Okay, so you're going to talk to us on VAT in the domestic perspective, issues and responses. Okay?
Yes.
All right, you have the floor now, and you have taken like 3 minutes of your time trying to sort out your technical issues. So I think you have to be fast. Good.
Okay, thank you very much. Thank you. It's my pleasure being here to talk about tax and precisely value-added tax. As Mr. Ben said, I'm going to talk about value-added tax in the domestic perspective. I will start with introduction, then go through the fundamentals of value-added tax in the domestic perspective, and then proceed to compliance issues, and then the contentious issues, that's the controversies of the tax, and make recommendations and round off. So I start now with the introduction. A value-added tax is an indirect tax. Indirect meaning that one person incurs the liability of the tax and another remits the tax to the revenue authority. It is a consumption-based tax, consumption on specified goods and services, and was introduced in the value-added tax decree of 1993. That's the history of VAT in Nigeria. It is usually called the consumption tax, and I said consumption, but indeed a supply tax. Why? Because the incidence of this tax is invoked upon supply, as well provided for in Section 2 of the Value-Added Tax Act. But then it is deemed that the person who has received the supply, received it not to waste it, but to consume it. So it is a consumption tax, but then it arises upon supply of taxable good or service as vatable under the Value-Added Tax Act. The burden is borne by solely by the final consumer. In the journey of production and to the consumption, from where the good is produced, and then it passes through several chains of distributor, the wholesaler, it gets to the retailer, and then the final consumer. The tax burden rests squarely on the final consumer. And when we talk about the mechanisms of input and output VAT, which is actually the payment mechanism of value-added tax, we understand this better. Administration of VAT is solely by the Federal Inland Revenue Service. It's the Federal Tax Authority. So if you're talking about VAT, you are only dealing with FIRS, and the states have no problem, no business with this. But then we see among the controversies, the legal tussle between the states revenue authorities, state governments, and the federal government over who is actually entitled to value-added tax when it conflicts with similar laws that have been enacted by some states, mostly Lagos State. It is distributed, even though collected by the Federal Tax Authority, it is distributed among the tiers of government. We see the distribution formula there. it appears that states will have the largest, being 50%. But when distributed among equally among the 36 states and the FCT, the states actually take the lowest share of it, and then the federal government has 15%, while local governments have 35%. VAT rates, it became a trending issue with the enactment of the Act 2019, which came into force in 2020, when a 50% increase in the rate of assistance that was provided in Section 4 of the Value Added Tax Act, now featured in the Finance Act, and it became 7.5%. And of course, there was a hue and cry over this massive increment, but that is the reality now. The controversy with this rate actually is its application in relationship with existing contracts, and when the value added tax liability arises in relation with the coming into force of the Finance Act. There are instances where contracts have been completed, and then it now remains the implementation of the contracts wherein value-added tax liability will arise. There are other incidents where the contract will be ongoing or the implementation of the contract will be ongoing. How would this be resolved? When we go into the controversy aspect of this presentation, I will throw more light on it. And then the VAT threshold is also a new feature of the Finance Act, in that the liability of registered persons who are agents of the federal government for collection of VAT, in other words, those who supply goods and services, there is a threshold now created such that if your monthly supply of goods and services is less than 25 million naira, you are not liable under this threshold. But if it is 25 million naira or beyond, then you have the liability to charge, remit the VAT, and account for the remittance to the Federal Inland Revenue Service. The taxable items, a very crucial issue. Which items are taxable? The taxable items, the Value Added Tax Act in its first schedule, it lists items that are exempted from value added tax, and there are others that are zero rated. Now, the principle that have been governing the taxation of goods, the imposition of VAT on goods and services, is defined by that exemption. In other words, any item of goods or service that is not expressly exempted and under the definition of supply of goods or services in Section 2 of the Act will be liable to value added tax. Now, before I clarify the distinction between value added tax exempt goods and zero rated items, the items that are totally exempt and the ones that are zero rated, which are usually missed up, I think I'll go forward and explain the intricacies of input VAT and output VAT. Now, the incidence of VAT arises through the mechanism of input VAT and output VAT. If you are talking about input VAT, the producer of goods or service, or the distributor of goods or service, or anyone in that line or in that chain of business, among that chain of production to distribution, incurs value added tax item, tax liability. The producer purchases raw materials and pays VAT on the raw materials that are not exempt. Then the distributor of the goods will pay to the producer, and thereby incur liability of VAT. Likewise, the wholesaler up to the retailer before the final consumer. Now, the person in the middle of the chain, when the person is paying, like the distributor is paying value added tax on the purchases that he has made from the wholesaler, that is input VAT. But when he is receiving value added tax from sales that he is, the further sales that is making of that item, that is output VAT. In other words, someone in the line of business, in that chain of distribution, when he purchases for the purpose of his business and pays VAT on it, it is input VAT. But when he receives, he further sells and receives, is output VAT. Now the liability for VAT arises when the difference between when there is a difference between the output VAT and input VAT. Because the input VAT is claimed, deducted from the output VAT, and then the excess of that output VAT over input VAT is remitted to the tax authority. That is how liability for remittance occurs. But when the input VAT exceeds the output VAT, such that there is nothing to be claimed VAT, in the VAT, then the business is entitled to a VAT refund from the tax authority, as much as he has not claimed this from his input VAT from the output VAT. Then he is entitled to receive a refund for the excess of his input VAT over output VAT. Now, this will better explain VAT exempt items and zero rated items. A VAT exempt item is free from VAT both on input basis and output basis, such that having incurred the input VAT, there is no output VAT. The 0% in the first schedule to the VAT is actually on the output VAT. The distributor or the business owner has incurred input VAT, but he cannot deduct this from output VAT because the output VAT is actually having the 0%. So it is 100% difference between input VAT and output VAT, and he's claiming the VAT 100% from the revenue authority, from Federal Inland Revenue Service. That is zero rated item. But VAT exempt item, there is no VAT at all. But zero rated, there is VAT, but 100% of the VAT, input VAT, so incurred, is recredited by the revenue authority to the business owner. In the first schedule to the Value Added Tax Act, there is a list of goods and services exempt, and the Finance Act 2019 has further widened this ambit by defining some controversial items like basic food item, which had no defined scope in the pre-existing value-added tax. Now, it has listed a plethora of goods and food items qualifying as basic food item, thereby being exempt from value-added tax. Now, in talking about input VAT and output VAT, I mentioned that the input VAT is wholly deductible from the output VAT, so that the person who is not the consumer, the people who are only distributing, making gains and doing their business, don't bear any liability for value-added tax. It is not all items incurring input VAT that the input VAT is deductible from the output VAT. So input VAT on overheads, services, general administration, and capital items. For instance, the capital items, they are charged as capital. They are not recurrent. They are not, so it is not claimable from the output VAT. It is only the items that pass as stock in trade that the input VAT incurred on them are deductible from the output VAT. Now I go into compliance requirements. The first stage of compliance is registration. In the past, there's a time lag between the time you start your business operations and when the law requires you to register. And if you don't register, then you are incurring penalty. But under the Finance Act, as soon as you take off in your business, the liability to register for VAT arises. Registration in the sense that you are in the VAT net to be an agent of the tax authority, charging VAT from your customers, remitting to the revenue authority, and rendering account for it through monthly VAT returns. But if your business has ceased operation, you are required within 90 days of the cessation of the operations to notify the Federal Inland Revenue Service so that to be deregistered. If you don't so notify them, it means the liability of registration and the liability of full compliance will still be on you. And when you don't, the penalty will now be invoked on you. Who shall register Of course, businesses, the chain of distribution, we see the producer, the wholesaler, the supplier. Government ministries and statutory bodies, they also register and they pay their own by reverse means. That's the direct means, not like the indirect means where the supplier of the goods or service will charge and remit to the Federal Inland Revenue Service. For government ministries and agencies and upstream oil and gas companies by virtue of Section 13 of the Value Added Tax Act, they have the direct responsibility of deducting the VAT as source and remitting to Federal Inland Revenue Agency. And likewise, no resident companies are required to register. They register through their customers, that's the clients or customers, the entities or persons with whom they have subsisting business. Yeah, they are their point of contact with the Federal Inland Revenue Service. For payment coexists with the monthly VAT return, and it's required that for the transactions of a month, by the 21st of the subsequent month, you are required as a person liable to value-added tax to render returns to the Federal Inland Revenue Service and also remit the VAT. There's a reverse charge mechanism. There's this argument that this is not a feature of our laws. It involves a situation, reverse charge involves a situation where the foreign or non-resident supplier of goods or services registers for VAT and then raises the invoice for payment, but the receiver of the goods or service here, the local, the resident customer or client will deduct the VAT and remit to the Federal Inland Revenue Service. That is a reverse VAT mechanism. Section 10, subsection 2 of the Value Added Tax Act provided for this, but not in very clear terms, in that several arguments arose. If this foreign entity does not include VAT elements in its invoice, then how would the liability of the local receiver of the goods or service arise? In other words, the arguments tilted to the slide that it is only when the foreign service provider raises the VAT invoice. But in the cases of Vodacom, the Court of Appeal upheld the argument that both duties are independent. For as long as there has been supply under Section 2 of the Value Added Tax Act by the non-resident entity to the resident entity, the duty of the resident entity while paying the price of the goods or service to deduct the VAT and remit it has arisen. That's a question of the Court of Appeal, and that is still subsisting. And this has been further clarified in the Finance Act. Federal High Court also told this line in the case of Gazprom and FRS, which involved non-resident service provision to resident entities. For dispute resolution on VAT, the dispute resolution forum is the Tax Appeal Tribunal and is in zones, in the various zones of Nigeria. You have the headquarters in Abuja, you have in Lagos, you have in the other zones. And then pursuant to Section 251 of the Constitution, there is the original jurisdiction, there's a jurisdiction as well of the Federal High Court. And this is not eroded by the jurisdiction of the Tax Appeal Tribunal, which only plays a complementary role. Controversy arose in the past under the old VAT Act that created a VAT Tribunal. But VAT Tribunal does not exist because there are two cases that brought up the statutory issues in that old VAT Tribunal. In other words, that the VAT Tribunal was sharing jurisdiction, original jurisdiction with the Federal High Court. The difference between that VAT Tribunal and the present Tax Appeal Tribunal was that appeals from the VAT Tribunal bypassed the Federal High Court and went straight to the Court of Appeal. But now, if the Tax Appeal Tribunal takes a decision for it to be enforced, it will be registered as judgment of the Federal High Court. In other words, there's no coordinate jurisdiction. But because of that straight appeal from VAT Tribunal to the Court of Appeal, the cases of Cadbury against FRS, Stabilini Visioni against FRS now exposed that that aberration, that legislative conflict with the Constitution, and that drew the death knell, drove the death knell into the cascade of drove the nail into the cascade of the old VAT tribunal. So you have an issue, you go to the tax appeal tribunal, but the jurisdiction and the capacity of the competence of the tax appeal tribunal is highly limited in the sense that it has defined procedure. You have to bring witnesses, there will be trial, but then there are some cases that there are no contentious issues of fact. It is just interpretation of the law. There are no issues of fact, and you did not waste the time of putting witnesses through the process, and then a judgment will be given. So for such cases that only have issues of law and no contentious issues of fact, it's better to take the case straight to the Federal High Court that has the jurisdiction to interpret the law on originating summons, and judgment will be delivered. When there is no compliance, failure to register, for the first month of that failure, there is a penalty of 50,000 naira, for subsequent months, 25,000 naira, failure to remit, a trust penalty of 10% of the VAT, and then interest that's payable at a CBN minimum rediscount rate. We come to controversies of VAT. First of all is the VAT rate. I've talked about the change introduced by the Finance Act. A very
Dr. Kuro, you have 5 more minutes, please, okay?
Thank you. A very controversial change indeed. But the greater controversy is, for existing contracts, the commencement date of this new rate is the 1st of February 2020. For contracts that were made, but they were not signed, but they were not implemented before this date, what is the fate? It will fall under the 5% rate. If the contract was signed, but then the implementation was now caught up with this commencement date, then it will not be 5%, even though 5% were contemplated by the parties when they signed the contract. If performance of the contract was ongoing, starting from the 5% era to this 7.5% era, then the rates applicable will be based on milestone. What's the milestone of performance before the 7.5% took effect? The controversial parts of the minister. In an article, I have raised an issue, a very strong issue about the powers of the minister under section 38, in that the minister has the power to increase the VAT rate and also vary or amend or modify the items of goods that are and services that are exempt under the VAT Act. I criticize on the basis that this power is more or less unilateral. Apart from being unilateral, there is no check on the power. Apart from that, the minister is more or less usurping the legislative power of amendment of the law. But then the law has given the minister power. This power can be abused because it is not safeguarded, in the sense that I believe that it was only incidental that other laws were to be amended by the Finance Act, and they had to bring in the VAT rate. If there were no need to amend other laws, the minister could, on his own, based on section 38, increase the VAT rate, and there's nothing the court can do about it because of section 38 of the VAT Act. And then I recommended the safeguard. I've stated the implication there. Constitutionality of VAT, it became a knotty issue in some cases involving state governments, especially Lagos state government. But then the matter was laid to rest by the Supreme Court in its position in Attorney General of Lagos and the Co-Hotel, where it invoked the doctrine of covering the field under section 4, subsection 5 of the Constitution, to say that the VAT Act, being a federal law, has covered the field of all consumption taxes. And so the law by the state government, the Lagos State Sales Law, will not apply again. There has been several arguments on that, but the Supreme Court relied on the strength of constitutionality of the Value Tax Act, that is an existing law under section 315 of the Constitution. How do we identify the goods that are liable to tax when they are not well defined? That definition has anyway come in the new Finance Act, the basic food item that was the most controversial. But then there are some judgments that highlighted this ill. But even though basic food item has been defined, there are still some items that are there that issue will arise over the scope of application. Then transfer of assets, tangible and intangible. It was controversial whether intangible assets will be liable to value-added tax, but the new Finance Act has copiously included intangible assets. This judgment was before the Finance Act, but now the issue of transfer of land is expressly excluded. Why? Because under the Land Use Act, the ownership of land does not pass to the person who buys the land. Even the person who sells is not the owner of the land. So it's not a supply of goods or service. It's only a transfer of a leasehold. Then the outstanding issue of properties fixed to the land, like buildings. In Latin, we say, what is fixed to the soil belongs to the soil. So the house on the land will be counted as the land, so that as land is expressly excluded, it includes buildings on land. Safeguards are recommended, like I highlighted the powers of the minister. The powers of the minister that I say is prone to abuse. There is a provision in section 21 of the Value-Added Tax Act providing for the VAT Technical Committee. Unfortunately, the powers of the minister to amend the rate, increase the rate, amend the schedule to the act is not subjected to any recourse to this VAT Technical Committee. I thought that would have been cured by the Finance Act, but it was not. But then it's not too late. Constitutional amendments, we have to know expressly, precisely the status of the Value-Added Tax or Tax Act under the Constitution, because even though a co-hotel case has been decided, other laws can be tactically and meticulously made by state governments, and the issue will still crop up. And then it will be subject to argument, the extent of the existing laws featuring as a concurrent law where federal authority will override state legislative authority. There has to be massive awareness creation, because I believe that there are enough laws. And secondly, the law, the instruments highlighting the laws, they may stretch the laws beyond the limit. And then thirdly, there are several issues that require awareness. And VAT is very, very widespread. It concerns everybody. So the level of awareness, like what we are doing here, is not for every Nigerian that are liable to VAT. So it is now on the federal inland revenue to devise means of greater awareness creation through the various languages, through the social media, through mediums that are available to all who are subject to VAT. Then digital compliance. Digital compliance will make for ease of compliance. But then there was a controversy that I encountered in one of my cases when I prosecuted for the Federal Inland Revenue Service involving some of the airlines, that this digital means of compliance was brought in to make automatic, to effect automatic tax returns and tax remittance. And the argument of the airline is that the liability to file VAT returns and VAT remittance on the 21st of the subsequent month is being eroded by this digital means. If it's automatic, that means you are shortening, you are making instant what the law has given them till 21st of the subsequent month to do. But then it is for both parties to reconsider it and see the good side of it. I have virtually stated my concluding points here, that the laws are quite substantial to drive VAT, but then a lot of things will have to be done on the laws and then the means of compliance, so that both the
Dr. Okoro, your time is up, bro.
Taxpayers will be better.
Your time is up. Your time is up.
Thank you very much. Thank you very much. Thank you.
All right. Thank you so much, Dr. Okoro. You exceeded your time, and that's going to affect other speakers. We are supposed to conclude this whole session in the next by 3 o'clock, and we have more like 54 minutes left. So I want to thank you for your presentation. For all those that have been asking questions, the The papers there will be shared to all the participants. So don't be unduly worried. We have your email addresses. We're going to share them. But I mean, questions are rolling. We have up to 40 questions. You know, good enough. Well, some questions for Tony and you, and I don't know how we're going to deal with 40 questions. So I want to plead with subsequent speakers to please make it as brief as possible. Olumide, you're a university lecturer. I know you guys like to talk, but please just make it concise and straight to the point. A lot of people are waiting for Femi Olarinde, who's going to give us the government perspective, and he needs quite some time to be able to explain. So, Dr. Jerome, please get ready. This input and output VAT is a technical area people require a lot of clarifications for, but during question and answer sessions, you'll be able to explain that a lot to the people. Thank you again for your paper. So, Olumide, please, you have the floor. Want your screens to come on now, and okay, fine. Please, straight to the point, so that if you can do it in 15 minutes, that would be fantastic.
Okay, thank you. Talk about VAT to global digital economy. The first thing we need to note is that the extant law is the 2004 VAT Act, which has been amended by, I'm on slide 3 now, which has been amended by the 2007 VAT Act, as well as the financial. We see that the 2000 and the Finance Act, the major thrust of the Finance Act was to amend, was to make provision that will cover multinational corporations, MNCs, and their digital activities. So we have amendment to Section 9 and Section 13 of the CETA, which that provides for significant economic presence. So that, and what this, I'm on slide 4. And what this means, what this does is that it applies to corporations that carry on digital transactions who don't have physical presence, which we call physical, permanent establishment or fixed base in Nigeria. And also, there are copious amendments to Section 2, 10, and 46 of the VAT Act, so that the problems encountered in the cases of Gazprom, Vodacom, Alan Gray, and CNOOC have been CNOOC. I'm on slide 5 now, and those amendments now take care of the issues that were in those cases. So we now move to the definition section on slide 6. Let's define what amounts to cross-border transaction. Cross-border transactions are mainly activities, business activities that move across the borders of 2 or 3 states. And then let's define digital products, as my topic entailed. Digital products are intangible, that means non-physical products that are traded on digital platforms. For example, we have videos on Netflix, YouTube videos, messages on WhatsApp, on Facebook, and all that. Even when you go to Wikipedia and download an article, that is an intangible good, an intangible product. So, and then let's look at Section 13, sub 2, paragraph C of the CETA, the new Secure Economic Presence. So it says that a company which emits, transmits, receives data, images, messages, signals, or sounds, those are intangible goods in Nigeria, and then uses electronic means or electromagnetic means or some other means, to trade in them, or to provide a participatory network like a Facebook. To the extent that that company makes 25 million naira threshold in Nigeria, that company will be taxable in Nigeria. So let's move to slide 7, which we now go to what the growth of cross-border transactions and digital products. Over the years, since the introduction of ICT, computer and technology, there have been massive growth in digitalization in the world, to the extent that the old rules, like the VAT Act of 1993, when it was made, there were virtually no computers. The old rules now have now overtaken, they are not fit to take care of the emergence of digital goods. So we now have a lot of countries and the OECD, Organization of Economic Cooperation and Development, Countries for Economic Cooperation and Development. They have come around so that there could be, they provide a platform for agreement so that they could find solutions to deal with digital transactions that are across borders, because the old rules are not fashioned to take care of this new digitalization and then the cross-border sales. So we now have a situation where they came about what we call base erosion and profit sharing, because a lot of a company is found in America, Facebook, Google, and then doing business in Nigeria. You find out that if there's no law in Nigeria to tax that company will be paying the profit in America. So the profit that is made for Nigeria will be taken to United States. So the OECD now came about what we call the 2017 International VAT/GST guidelines, so that to address these issues. It's not only the OECD. Over the years, we now have found out that there has been over, as of April 2020, we now have over 4.5 billion people using internet. And then in 2018, the European Commission proposal on digital tax showed that as of 2018 itself, the EU, on that 3% that Tony talked about, the first speaker, will make 5 billion euro. So you see how gigantic the business of, I'm on slide 8 now, you see how gigantic the business of digital products, sale of digital products are in the world. And then even in Nigeria, I'm on slide 9 now, the NIPC noted that by 2020, digital companies will be making $88 billion from Nigeria. So that now takes us to examine how could we tax these the trade on digitalization, because it's now becoming very important. So we now go to look at a lot of cases. For example, look at the Coca-Cola case from Kenya, the Vodacom cases and Syria cases. You will see how issues have emerged. But what are the challenges? We are now going to slide 11 now. What are challenges that face national laws, like Nigerian laws, like the VAT Act, the Finance Act, and whatever? What are challenges that will face Nigeria in providing laws to deal with cross-border transactions? The first challenge is the power to make laws. Does Nigeria have power to make law that will bind a company not registered or domiciled in Nigeria? Google is United States. Can Nigerian law affect Google? And the second issue is the power to collect. Can Nigeria actually, even if Nigeria makes a law, can Nigerian collect from Google? I mean, the profit, tax on profit that arise from Google's transaction in Nigeria. So that's another issue. Then even under the domestic law, there are issues. For example, what constitutes supply? What constitutes, I'm on slide 12 now. What constitutes supply of goods and services in Nigeria? What constitutes a good? What constitutes a service for cross-border transaction taxes? So I'm on slide 13 now. And then there are issues about what constitutes imported services and imported products. And then there are issues about what amount If a non-resident is mandated to register in Nigeria, there are various the cases are written in Nigeria. Look at subsequently, which is the international organization. I'm now ECD came out in 2017. Implementation guide. I'm now on slide 16. Destination principle. Application of domestic laws. How do we does Nigerian groups profit net the OECD that be the basis. That's and then OECD now done to make another recommendation. It divided activity into two: business to business and business to consumer. Like something. That's why we call B2C. B2B cases where the supplies of goods or services is being made by a business to consumers. The OECD recommends that the non-resident company must come to the country of the importer and register there and collect the VAT there and then pay it over to the local country. But as to business, the OECD recommended reverse charge, i.e., that the importing business, the business located in the local country, like in Nigeria, which is receiving a service or good from outside Nigeria, will self-charge itself. I mean, assess the tax and then charge and then remit it. But although some countries have accepted those recommendations, some other countries have not. What they have done, some countries have expressly said, no, every non-resident company that wants to supply goods, I'm now on slide 19. Every non-resident that wants to supply goods must register in the local country. Other countries now said, no. What we do is to impose VAT on the e-marketplace or the carrier. You have the website like the carrier e-marketplace like Amazon, like Jumia. So if Conga, if you want to buy something and all that, you can go to that. So they say, okay, it is only those marketplaces who collect the VAT and then remit it. They will not even talk to the seller, the non-resident seller. So those are the two other ways by which other countries have dealt with it. But there's a peculiar thing that happened in America. The United States Supreme Court, in the case of Wayfair, W-A-Y-F-A-I-R, now came and said that, I'm now on slide 20, now came and said that even such rule as to destination principle would apply to subnationals, which is very important, as noted by Dr. Okoro, very important in Nigeria. In our case, the Supreme Court has noted that a state in Nigeria can collect sales tax on inter-activities occurring within the borders of the state. So, therefore, in America, in Wayfair, there's now what we call nexus, economic nexus. So, if a company is located outside another state and is doing business in one state and doesn't have a physical presence, it will, be subjected to sales or use tax in the United States, similar to VAT. So that is an innovation, and then could apply to Nigeria as well. So moving from that, we now come to Nigeria, because I'm skipping through, because I understand there's no time. So we now come to Nigeria. we are now on slide 22. What are the statutory and the judicial principles that now affect cross-border transactions in Nigeria as of present? So the first major innovation in the Finance Act was the amendment of Section 2 of the VAT Act. That amendment totally took care of a lot of cases. Let me, if you go to slide 23, there's a full definition. There's a full itemization of what constitutes a good that could be supplied in Nigeria. Remember, that was the issue in CNOC. In CNOC, somebody, an individual, a company applied for OPL and then got an OEL and was qualified to apply for OML. That company now sold the right to apply for OML to another person. Now the issue is whether that that sale of the what we call the chosen action and incorporated right could be subject to VAT. That has been taken care of now. Now Section 22A of the VAT Act now provides that what is a good that is deemed supplied in Nigeria. Remember, an intangible product is an intangible good. When can it be deemed to be supplied in Nigeria? So it now says that good, the supplier, the good must be present in Nigeria at the time of being supplied, number one, or the good is imported into Nigeria for use in Nigeria, or the good is installed in Nigeria, or the good is assembled in Nigeria. If any of those four things occur, and then the last one is that if there's a beneficial ownership or a right belonging to a person in Nigeria, which could be exercised or registered in Nigeria, those 5 instances, a good would be a Nigerian good and then subject to VAT in Nigeria. Remember in CNOC, it was an OML that could be exercised, an OML right that could be exercised in Nigeria. So that now is subject to VAT in Nigeria. Remember in Vodacom, it was receipt of good. Remember if you buy Microsoft installation setup, and you install it on your laptop, even though you bought it online, now it's being installed in Nigeria. It is subject to VAT in Nigeria. And then Section 22B, Section 2 paragraph B of the VAT Act now says that what amounts to services that could be subject to VAT in Nigeria, the service must be one that is provided in Nigeria by a person in Nigeria, or the service is being provided to a person in Nigeria, irrespective of, regardless of where it's being provided from. In Alan Gray case, a South African company entered into contact with a Nigerian company. Nigerian company will provide the service to the South African. But actually, the South African now redirected those services to other companies in Nigeria. Now, the Nigerian company that did the service, they said that, oh, I exported them. And under paragraph 4, part 2 of Schedule 1 of the VAT Act, exported services are totally exempt. But the issue is that although the Nigerian company was exporting them to the South African company, but they are being redirected to Nigeria. Now the case, this amendment now says that if it is being provided to a person in Nigeria, irrespective of where they are coming from, okay, it is now a Nigerian service, which is subject. So in those, the amendment Section 2 takes care of a lot of digital transactions that were previously contentious. So and then, so if you look at this one of Alan Gray, it is discussed on slide 25, I believe, to 26. Okay, so those in that case, it was held that although the services are provided to South African company, but they actually been enjoyed in Nigeria. And then in Kenya, in the Kenya case of Coca-Cola, what happened is that there was a Coca-Cola company in Kenya, and then it entered into a contract with an American Coca-Cola company. The contract was signed in the United States. The acquisition was made in the United States. The payment was made in the United States. But the contract required the Kenya company to market Coca-Cola brands in Kenya by television, radio, newspaper, advert functions. Now the issue is, now the Kenya company said, no, I'm not paying VAT. The VAT tribunal there said no, that these activities took place in Kenya, And the ultimate consumers, people who actually enjoy, who view the television, who watch the radio, who read the newspaper, attend the functions, were actually in Kenya. Therefore, the activities were provided in Kenya, although the transaction was, the money and the election were made in the United States. In other words, that cross-border transaction of service was actually taxable in Kenya. So that's how the law is changing now, so that Nigeria now has an adaptation of destination rule, and then as well as an adaptation of the B2B and B2C under the OECD guidelines. And then another case I want you to look at, which is the Kenya case is on pages 27, slide 27 to 29. And then we now go to I now mentioned that slide 30, slide 30. A combination, even if there's a doubt as to whether a certain service or an intangible good is subject to tax in Nigeria, a combined reading of section 2, sub 2 of the VAT tax
you have 5 more minutes.
All right.
No, your time is up. We're doing 5 more minutes.
I will finish. With section 13, sub 2 of the CETA, which talks about significant economic presence. Remember that one actually recognizes data, images, sounds, and all that. So if you read those two together, you can tie any, if there's an issue, any transaction involving intangible service or intangible product or cross-border will be tied to Nigeria. And then finally, the case of Vodacom was very contentious. In that case, NSS, a Netherlands company, which in this case I discussed on pages slide 31 upward. So a Netherlands company, broadcasted bandwidth services to Vodacom so that Vodacom can sell to its consumers in Nigeria. Now, what happened was that the Netherlands company never came to Nigeria. It never registered, did not provide an invoice, and did not raise an invoice, and did not provide a VAT. So the Nigerian company said, well, this is not subject to VAT. Number one, the foreign company was not registered in Nigeria. Number two, even if it was registered in Nigeria, it was not a good or service in Nigeria because it was online in the sky by the satellite. Number two, even if that, the foreign company did not raise an invoice and did not state the VAT that should be paid and all that. So the court, disagreed and held that even one single transaction, if you go to pages slide 34, even a single transaction is subject to a supply. And then number two, the court held that because the service, quote unquote, is being seen, I disagree. What was being sent was not a service. It was a good, an intangible good within the definition of section 2.2 and section 13.2. Although both courts, the federal court and the court of appeal, refer to it as imported service, it was actually an importation of intangible good, bandwidth services. There was no need for a professional from NSS coming to Nigeria, so there was no service. It was importation of intangible goods. Anyway, so the court held that because it was in Nigeria, the foreign company was trading in Nigeria, and then the fact that that an invoice was not raised did not matter. The foreign company would still have to self-charge. The court expressly adopted destination principle and the reverse charge. And then if you now go to finally, if you now go to page slide 38, I reproduced the whole content of the new section 10 as Dr. Jerome, that's slide 38. The new section 10 actually absorbed, although there's a requirement to register as a B2B, as a B2C. That one is still there, and a non-insurance company will still register. But now if you look at section, the new...
You might have to round up, please.
Okay. The new sub-theory says that the foreign companies, the ones to must raise an invoice and the VAT. And then the new 4 Section 10.4 says that even if foreign company does not raise VAT an invoice, the Nigerian company must assess debt and pay. The same thing is noted in Section 14.3. But there are some contentious issues that's enough. That's on my last page, slide 40. I will save time. Those issues have not been dealt with. I hope they will be dealt with later. Thank you very much.
All right, thank you so much, Olumide. I don't think I want to go into summarizing your paper. Tony, let me finish. As soon as Femi finishes, I might have to give you an award. You've been the only one that have been able to stick to your 20 minutes. So let me see whether Femi is going to share that award with you, or you get it alone. Olumide, you made some very good points. Do we have power to make such laws to be able to enforce the foreign VAT? And then, even if we make that law, can we collect it? How can we go and enforce it against Google? Among other foreign companies. That remains a very big problem. So, but please, we're running out of time. Femi, let's hear the government perspective. Talk to us. Stamp duties, people have been shouting, raising all sorts of issues and what's going on. The new regime of stamp duties, matters are rising. Please, you're the only one that is in the best position to talk to us, but please try to keep to your 20 minutes. We have 58 questions already. I don't know how we're going to answer these questions, but as much as possible, keep the time so that we'll be able to, because this session will not make any meaning if we're not able to avail the people opportunity of having their questions answered, as many of the questions as possible. So Femi, you have the floor. There's a prize for people that will keep to the 20 minutes. So far, only Tony has qualified for that. So I hope you'll be able to want to share that prize with Tony. Thank you.
Okay, thank you. Yeah, good afternoon. My name is Olarinde Michael Olufemi. I work with the FRS. I will go straight to my paper. Thank you for inviting me for this program, and it's always a pleasure to share knowledge. Okay, my topic, the organizer first said I should speak on the new stamp duty regime in Nigeria, matters arising. Okay, if you check my papers, I've redefined my topic to be stamp duties regime in Nigeria, matters arising. Why? Is because there's no new stamp duties regime. Because stamp duties has been in operation in Nigeria since 1923, and there is no new regime. The last law we are implementing is the law that has been enacted since 1939. So that's my opening statement. So I'll go straight to my paper. I have about 7 areas to speak on. I'll go straight. So I say history of stamp duties. If you check my slide, it started in Venice in the year 1604, and Spain in 1610, go on to Netherlands in 1620, France in 1651, the Denmark in 1657, Prussia in 1682, England in 1694. The essence, basic essence of stamp duties, stamp duty is a tax. That's the first thing we should first know. It's a tax, and the basic essence is just to get government involved in contracts entered into by citizens in order to protect
Femi, yeah? Sorry, can you maximize your screen so that we can see it clearly?
Oh, okay. Sorry, okay.
Yeah,
Is it better?
Okay, it's better now, yeah.
It's better? Okay, okay.
Yeah.
Okay, so I said the basic essence of the stamp duty is to get government involved in citizens' contracts, so that in case of litigation, in case of conflict, government can actually honor whatever agreement parties have gone into. So in Nigeria, the stamp duties started we first introduced in 1923, I think by ordinance number 26, and later it was repealed and with the ordinance number 41 of 1939, which is the law we practice presently. The law has been enforced since 1939. There's been several amendments in 1941, 1942, 1946, 1950, 1953, and 1948 by resolution, 1951, 1954, 1955, 1956, and a recent amendment in the Finance Act. So that is the amendment we have. So the most recent amendment now try to modify things by recognizing technology and e-commerce transactions in line with global practice and current economic realities. So legal regime of stamp duties in Nigeria. There is a basis for stamp duty in the Constitution, specifically in section 116. We also have the Stamp Duties Act, SAT LFN 2004 as amended. There's a provision for stamp duties in the Federal Inland Revenue Service Establishment Act. Then the recent Finance Act 2019. Also, the Joint Tax Board, through the powers in section 4.2, had an harmonized schedule of stamp duties rates in 2002. So stamp duties, how is stamp duty charged? It's being charged in two forms. We have what we call the ad valorem rate, where the duty is payable in percentage of the consideration of an instrument. And the second one, we have the fixed rate, where the fixed sum is chargeable irrespective of the consideration on dutiable instruments. So we have what we call the schedule to the Stamp Duties Act, which clearly lists out all the rates, all the chargeable instruments and the rates applicable to them. I have tried to bring some of this rates here. So when you see what we call the ad valorem rates, we have what we call the contract note, which is charged at 0.08%. We have the deed of assignment, 1.5%, insurance policy at 0.075. Then we go to the controversial lease and rent that has been been topical in recent time. So lease rent has a graduated rate of 1 to 7 years, which is 0.78%. Above 7 to 21 years is 3%, while above 21 years rent is 6%. So we have what we call the fixed rate, which is a fixed sum of money, irrespective of what the document is about. So we have the proxy form, which is 500, the bank deposit transfer, which is 50 naira, certificate of occupancy, 1,000, guarantors form, 500, and receipt 50 naira. We also have many other rates, almost about 100 and we have about 140 something items on the schedule. So stamp duties on lease and rent, from what we've been hearing in the media and by commentators in recent time that FRS had introduced stamp duty on rent, I would like to clarify that stamp duties on rent is as old as the Stamp Duties Act since 1939. And that has been in the Act since then. Reduce new taxes, now fix new rate. So the rate of duties, I have explained this before, on lease and rent is as follows. So I'll go over to section 23. 3C clearly states that lessee. So if you ask who is supposed to pay, the law clearly states that the lessee, who is the tenant, is responsible to make this payment. So, okay, self-conflict of authorities. In recent times too, yeah, we've been hearing state government trying to lay claim to some stamp duties. Federal government have said no, it's our purview. And if you check section 4.1 and 4.2 of the Stamp Duties Act, it clearly delineates what is chargeable and what is to be administered by both the federal government, by either the federal government or the state government. And when it concerns a corporate entity, wherever you see a corporate entity in a transaction, it is the stamp duty accrued into that transaction is payable to the Federal Inland Revenue Service. However, when the transaction is between two individuals, it's payable to the state. So people have said, okay, if Adamu transfers money to Shegun, that means the transaction is between two individuals. I would like to state that, of course, you know there is the bank who owes the money. Adamu has given the money to the bank, yes, and the bank transfers to Shegun, who receives the money. The principal party in this transaction is the bank. And the law clearly states that companies includes the bank. That is why such transaction, stamp duty payable, goes to the federal government. So the second one has been in the news in recent times about the FRS versus NIPOST. And if you check section 4.1 as amended by this Finance Act, as clearly provides that the Federal Inland Revenue Service shall be the only, and it qualifies as only competent authority to impose, charge, and collect duties upon instrument if such instruments relate to matters between a company and any. So to that extent, also, if you go ahead to the paragraph 6 of FRS Establishment Act, it lists the laws and legislation to be administered by the service, of which the Stamp Duties Act is clearly listed as paragraph 6. So there is no contention about it. There should be no contention about who to administer this law, as is very well clear in the law. Like we said, it is a tax, and it's only the tax authority that collects tax. Okay, I go ahead to spreading the net, digital transactions. Now, Section 2 of the Stamp Duties Act was amended to expand the scope of instrument liable to stamp duties to include electronic documents. Of course, the old law was enacted in 1939. It couldn't have foresaw the realities of now, that you could actually stay somewhere and be making transactions, issuing documents to somebody in the UK or in the US, or even around you here. So the amendment was done to ensure that electronic documents are captured, adequately captured. Also, the amendment also provides that you don't need to have a physical document. You don't need to get a physical stamping, but by denoting your document, you can use what we call the electronic stamping. As I go ahead, I will let you know about what kind of electronic stamping, what it means. Also, all written, printed, dutiable instruments or receipts are chargeable. So whether it's printed or it's electronic, dutiable instrument receipts, whether in form of electronic media content. If you issue an instrument and you decide to leave it electronically, or you put it in a floppy disk, no more floppy, you put it in a CD-ROM, you put it in a hard drive, you put it wherever magnetic tape you put it, it is still an instrument. And research will be chargeable to stamp duties. So if you exchange emails where you draw up your instrument and you never printed it, it is an instrument. If you exchange short message services, maybe as an acknowledgement for a payment received, this is a receipt and I'm sure I guess the Evidence Act has been amended to ensure electronic document too is allowed. So if you receive an instant message by somebody acknowledging a payment from you, and you know that definitely in future, in case you want to avoid when there's a litigation, for the person not to be able to say, no, I did not receive such money from you. You can go ahead without, whether you print it out or an evidence that you receive such SMS for that person, pay your stamp duties, and you can present same as evidence in future. So we say irrespective of how you store your document, with the amendment we have on law, stamp duties we apply. So all printed receipts, including POS received, fiscalized devices received, automated machine printouts, and other forms of written or printed acknowledgement. They are dutable. These are dutable instruments, and they are all chargeable to stamp. Okay, I've already explained this. So I'll go ahead to direct electronic printout, impression. Okay, so how do you mode of denoting duties electronically? So it's either by direct electronic printing. So if you go to a supermarket or someone is issuing a receipt to you, it can have the impression, duty paid on such documents. And I'm sure that if you see our checkbooks, if you see a column or you see a dividend warrant, there's a place that says duty paid. This is a direct electronic printing on the document or by impression on such document. So this, or an ink, or what we call electronic tagging. Electronic tagging is also a form of electronic, the way you denote an instrument electronically. So also issuance of what we call the stamp duty certificate. So you can go up to FRS portal. We have what we call stampduties.gov.ng, where you can describe your instrument, upload your instrument, and immediately you get what we call, you get a certificate being issued after payment, because the portal leads you to where you can make your payment to. So I move on to, so for banks, when you do an electronic transfer, banks and other financial institutions are required to charge appropriate stamp duties on qualifying transactions. Stamp duties are charged, shall be remitted to the service. So like I said, there's a threshold for this, and the threshold is 10,000 naira. So like the provision of Section 89 clearly mandates the banks to carry out this and charge and remit same to the service. So it has to be 10,000. And for accounts, I saw someone ask that question. For accounts that belong to the same person in same bank, is not liable to stamp duties. So if you transfer to yourself in the same bank, you are not liable to stamp duties. So effect of not stamping. There's been people who have said that stamp duty is not, some have said that stamp duty is not compulsory. It depends on when, if you choose to stamp. But I would say, if it is not compulsory, there are provisions in the law that says that if you do not stamp it within a specified period, you are liable, you'll be chargeable to penalties. So Section 23 of the Stamp Duty Act provides that any unstamped or insufficiently stamped instrument may be stamped within 40 days from its first execution, except such days is reduced by an order according to Section 23(8) of the Stamp Duty Act. So consequently, the underlying document will not be admissible in evidence in any civil proceedings in a court in Nigeria. So like we say, the essence of stamping your document is so that it can be admissible in evidence in case of any issue. However, being a tax, one of the features of a tax is that it is compulsory. A tax is a compulsory levy charged by government. If that compulsion is not there, it is not a tax. And for something that has a penalty, it simply means that it is compulsory, and the law has specified the time within which such instrument is to be stamped. Also, effect of not stamping, it shall attract prescribed penalties under the Stamp Duties Act and under the Federal Inland Revenue Service Establishment Act. Yes, a lot of people have said the penalties chargeable under the Stamp Duties Act are so meager and outdated. However, the FIS Establishment Act has several penalties that are in tune with present realities that can be applied on such taxpayer. So you go over to, and the next one, among penalties chargeable are terms of imprisonment. So such person can also be, can have a term of imprisonment. So that is the end of my presentation. You can bring in your questions to clarify where you do not understand. Thank you.
All right, thank you so much, Femi, Mr. Larinde. I think you did it like in 20 minutes, you know, or slightly above 20 minutes, you know. So I'll have a prize for you and Tony Gimpo for sticking to time. Thank you so much.
You're welcome.
By our arrangement, we are supposed to leave here in the next 5 minutes, but let's see how we can accommodate and extend the time a little bit. So we have question and answer sessions. Some of the questions have already been answered. I mean, we have 72 questions.
I've answered most of them.
Yes, you know, so I would go again, like we said, all the, we have the papers from all the panelists and all that, and they will be shared among all those that have registered for this. So don't panic, I would say, you know. Now there are questions. This question: a non-governmental organization with 100% non-for-profit transactions, medical or humanitarian, and whose audit fee has been included in the donor-funded budget, should NGO pay VAT by the external auditors? Should NGO pay VAT? This question is from Adeyemi Adesanya. Olumide, can you take that question?
Sorry, what's the question again?
A non-governmental organization with 100% as an NGO, okay, and whose audit fee has been included in the donor-funded budget. Should NGO pay VAT charged by the external auditors? Should the NGO pay VAT that's charged by an external auditor?
Okay.
Can I take that?
Yes. Go on.
Was that Femi?
Who wanted to take the question?
Femi,
go on. Yeah, Femi, please go on.
Okay. Well, to answer that question, the NGOs are actually not exempted from VAT. Unlike the notion that people know, they are zero rated. However, zero rated too, it's only limited to goods. It's only limited to goods supply and not services. So when NGOs receive services, such services are liable to VAT. That's the law.
Okay. All right. I want to get this question that is another VAT question. How do we treat VAT on transactions funded by international organizations such as USAID, EU, etc., that claim they are VAT exempted by FRS, but come around asking for VAT remittance on such transactions?
You want me to take that too?
Femi, if you can, please. You are the man from FRS, okay. So I want to get the question.
You know,
yes.
You know what? VAT exemption is not on the fund you use. It is about who you are and what you are buying. So if there's an exemption for the goods you're buying as an NGO or whoever, such exemption shall cover whatever you're buying. However, now, if you get a fund from donor-funded person, and you use such goods, you use such money in buying goods used in your humanitarian donor-funded project. Now, I'll clarify that if somebody is an NGO, you decide to carry out an outreach, maybe a COVID-19 camp, or you go to a displaced people's camp, you buy things, materials for them. Yes, those are good use. Specifically in those funded projects, such will be exempted irrespective whether it comes from donor agency or it's your fund. So it's not about who is giving you the fund. So if they are exempted, if there's such exemption. So that is the clarification I'd like to give. Hello?
All right. Now there's another question, okay? It says, when a property of a document doesn't have a value and needs to be stamped, who has the obligation to get it valued? I'm sure maybe something like a deed of gift, you know, who has the obligation to get it valued? Is it the FRS or the taxpayer? And who are the professional values on this circumstance?
Okay, to answer that question, for every state, FRS has tried to liaise with the land registries and the certain professionals to ensure that we have the approved value for almost every property. So when you approach our stamp offices, they show you the approved values of which we are used to charge such duty. So if such document is not valued, there's always a provision. We have specific valuation has been done by experts and the state authorities. So it's not just an FRS document.
No, can you answer that question again? Make it a bit clearer.
Okay, you said whose responsibility it is to value the document. That's what you
Yes.
said. Okay, so what I said is that for such valuation to have been done, most of our offices right now have liaised with the relevant state authority, who probably has the authority to value property in the domain, and the registries have information, and in conjunction with other professionals, FI have a list of evaluation of many properties in many of our jurisdictions. And so that is what FI uses to do its assessment presently.
Okay, this question is for Tony. I'm going to get to you soon, but this question is for Olumide. Are there any enforceable laws that will make foreign companies like Google to declare the income as well as the profit derived from Nigeria, withholding tax as an advance payment of income tax being deducted from their payments will just be a mere revenue generation exercise? Are there any enforceable laws that will make foreign companies like Google to declare the income as well as the profit they derive from Nigeria?
Well, yes. To my knowledge, the only result that Nigerian can the only avenue open to Nigeria is to exploit the provision of section 10(4). Okay, it said there's a B2B. If Google supplies some service or good to a Nigerian company, the Nigerian company has the obligation to self-assess and charge VAT if Google if Google fails to issue VAT or whatever. So it's against the Nigerian company that the Nigerian tax authority will go after. So, but the same thing as to supplies to consumers directly. That was the problem faced in Canada as to their GST. It is difficult when a consumer, an individual, directly purchases something from Google and then, or any other foreign company, and then you ask him now to approach, the FRS to pay the VAT or whatever. So it's not possible. So that was what happened generated a lot of issue in Canada as well. So the only avenue, I believe, open to Nigeria is to use Section 10 sub 4 and say, okay, you, the counterpart business in Nigeria, you come and remit the VAT that is accruable on that transaction. Other than that, there is there's what we call, I think, inter-country cooperative information. I think information sharing agreement, or so sort of an informal cooperation between countries by which they can share information about financial transactions occurring within their domain. Other than that, if there's no recourse to Section 10 sub 4 or the interagency sharing of information, I don't believe there's anything Nigeria can do about a foreign domiciled company.
All right, thank you. Igoniko, are you on? Igoniko Adekunle?
Yes, I am. Good afternoon.
Okay, good. Good afternoon, Igoniko. You are given permission to ask your question. Igoniko was one of our speakers at the first tax webinar. Thank you very much, Mr. Obidegu, and good afternoon to all the panelists. I've thoroughly enjoyed listening in, and it's a wealth of experience for me as well, and I've picked quite a lot of things there from. My question is for Mr. Olaride regarding the Stamp Duties Act. I just want a clarification. I see you smiling. It's a very simple question, and it's regarding considering the fact that stamp duties can also be denoted by adhesive stamps, and the provisions of the SDA also, that's the Stamp Duties Act, also tells us that in such scenarios, postal stamps will suffice. Okay, so what is the issue of FIRS then regarding the Nigerian Postal Agency on sale of these postal stamps and collection of the sale of those postal stamps, as I understand it? I just wanted to understand and hear your view regarding that point. Thank you, Mr. Obidegu. Thank you.
Okay, actually, yeah, I'm here. Can you hear me?
Yes, please go on.
Okay, I just want to confirm first, Mrs. Adekunle, right?
Yes.
Are you a lawyer? I know this is.
She's a lawyer.
Okay, good. Section 5.2, where you're trying to quote in the Stamp Duties Act, says where adhesive stamp is to be used. Postage stamp may, and I want you use the word will, and I want to actually direct you to go back and check the law. It says postage stamp may be used, subject to a law or regulation. I want you to study it, and I'm sure where such provisions are made, that means there must be a regulation or a law to allow such. And that will be the end of my question. Actually, that will be the end of my answer. I believe that should answer your question. Thank you.
Tony, somebody asked us a question saying, with all these taxes you listed out they pay in UK, how do they survive? And how would you advise the Nigerian government on effective tax collection?
Thank you. All right, well, we survive because we choose to ignore the facts. The pound in our pocket is probably worth threepence. We live in a transaction economy. tax is just a fact of life. It's another cost of business. But yeah, we make it through, you know, because ultimately, you know, you only pay tax if you make a profit or you're earning a salary above the amounts one can earn for free. The social compact works, and we all do well. How can the Nigerian government, how can the Nigerian people emulate the better parts of the system and make it work? Yeah, good question. There are a number of things that work against you. You've got a federal system. Here in the UK, it's just, you know, one government effectively, one tax policy, and it applies across the board. And you know, there are cultural differences. I would say, rather than trying to constantly find new innovative ways of squeezing the population, come up with, you know, as level playing field as you can. Try to create an elitist meritocracy. You know, start with education. And from the populist side, it's really important, you know, work with the system. Ultimately, the system will work with you. And as long as both sides, you know, enter into the bargain willingly, open minds, and, you know, open hearts, then it will work. It's where, you know, governments, you know, are at odds with their populace. You know, that's when we start to get real problems. And, you know, here in the UK, there's still a political divide. You know, hard left, you know, hard right. We dodged a bullet, thankfully, you know, not getting a Marxist government. Nonetheless, you know, the current Tory government, I suppose, is more one nation Tory than before. But because of circumstances, it's having, on the one hand, people the chance to, you know, survive COVID, and on the other hand, we're going to have to claw it back at a later date. So there is no perfect answer. You know, we live in an imperfect world. But anything like a balance where both sides play ball should work out for the best.
All right, Tony, thank you so much. Another simple question on stamp duties. It says, when a company buys cement, blocks, sand, and other materials directly from a roadside vendor or registered individual for building, is the company liable to pay VAT on all this? Dr. Koro, can you answer that? You just walk across the road and buy sand and cement from the guy.
Pardon? Hello?
Are you liable to pay?
There's a break in the audio.
Okay, I said,
yes.
When somebody walks across the road to buy blocks, sand, and cement, and
Yes.
other building materials directly from a roadside vendor, is the person liable to pay VAT on that?
Yes, the determinant of liability to pay VAT is the exemptions. If it's not an exempted item, no matter the circumstance of the purchase, the duty to pay VAT arises. It is not the purchaser that deducts the VAT. It is rather the seller that will receive the payment and deduct the VAT and then remit to the Federal Inland Revenue Service. So most of the purchases, if the regular purchases we make, we don't even know that many people don't know that they are paying VAT on it, because the duty to charge the VAT, the duty to deduct it, the duty to remit it to Federal Inland Revenue Service is on the supplier of the good or service item.
All right. One more question on whatever. I said, what is the position of FIRS on VAT as it applies to ticketing companies, bearing in mind that airlines deduct VAT and withholding tax? There was an old memo from FIRS exempting them. please clarify. Mr. Larinde, are you on?
I am on. I'm here.
Did you get the question?
I go loud and clear. I got it.
Okay,
I've actually answered most of the question in the question and answer session, including even the one Dr. Jerome just answered. What it should be clear to the person is that for the ticketing, yes, the ticket is charged with VAT. It's already part of it. However, the man who is supplying the ticket provides a service to the ticketing company upon which he receives a consideration for his service. So it's expected that a portion of his consideration of the consideration which he receives is the service for which he received consideration for is also liable to VAT, for which he needs to account for. So that is the aspect where the ticket did not cover. The VAT which would have been remitted by the airlines will not cover. I believe I've answered the question.
To add to that, the VAT there is not on the ticket, is rather on the payment, the service that is being rendered by the airline. The ticket is only a medium of payment. So what that payment is made on the purchase of the ticket is rather payment for a service that is being made, and so it's liable to value-added tax.
So sorry, before I also go about the question that Dr. Jerome answered, I'm sure the person that asked that question said if you buy cement from the roadside, I know he's trying to look at it that the roadside vendor is probably a small company, a small person below the threshold. So yeah. probably does not have the duty to charge and collect VAT. So for me, the first thing to first check is that most people selling cement are not small companies, irrespective. However, if such company is small, or if such person, because VAT is not about companies, if such person is lower than the threshold of 25 million, the man who is supplying, who is buying, is expected to self-account for the VAT and remit to the service.
All right. I have Mr. Collins Enebuse. Collins, are you there?
Yes, I'm here. Good afternoon.
Good afternoon. Make it brief, please.
Okay. Please just pardon me because I would like to some narrative. Thank you very much, everybody, and particularly Larry, in terms of your expose, particularly as it relates to the powers of FRS as it affects the rates. You made reference, we were talking about the stamp duty regime, the JTB harmonized rates of 2002. Now, I've taken the time to look at the FRS integrated stamp duties platform. I realize that some of the rates there do not tally with what you have in the Stamp Duties Act, but they tally with more of what you have in the JTB harmonized rates. And in trying to allude to the powers of the FRS relying on the JTB harmonized rates, you made reference to section 4, sub 2, which if you read that section, it specifically says that, talks about the jurisdiction of state revenue services, state inland revenue services to stamp duty transactions between individuals as may be agreed to by the federal government. Probably you're referring to the JTB rate as a product of that agreement. But if you go to section 116, it says that the schedule may be varied by resolution and order by the National Assembly. And in reading that section 116 sub 1, it talks to the rates upon which duty will be levied on transactions. And except the National Assembly amends, varies all of the rates identified in the schedule, that no other body has the powers to so vary rates. If you look at contracts, for instance, the contract is deemed to be charged at % by JTB harmonized rates, and also the integrated stamp duties platform. A cue from what is happening right now, you see that the federal government, through the enactment of the Finance Act, varied the Section 89, which speaks to receipts, by expunging that provision and creating new provisions speaking to new rates, as against the rate of 2 kobo for every 4 naira as contained in the previous Section 89. That is the way we expect that it should be. But if you are looking at the JTB harmonized rates, I am afraid that it does not tally with the provisions of the schedule as contained in the Stamp Duties Act. So I do not know where FRS or why FRS is relying on the JTB harmonized, where that has not been approved by the National Assembly. And after 2002, the National Assembly issued a directive to FRS, requesting FRS to disregard the JTB harmonized rates. But to date, we are seeing rates in the JTB harmonized rates that are in variance with what you have in the Act. So perhaps, see what your reaction in this regard may be. And secondly, just to add a few more points, the integrated form not has been developed without taking recognition of the exemption provisions you would find in the Stamp Duties Act, particularly the schedules. So I don't know how taxpayers would want to make payments or comply using the platform of the integrated stamp duties platform, whereas you have rates or rather exemption provisions in the Act, but not contained in the platform.
All right, Femi, I hope you got the questions. I mean, this is more like, I don't know whether it's a question or submission he made, but I want to make a comment.
Okay, he didn't ask a question, he made submission, so there's nothing to answer. Like he said, he has quoted the law correctly. I will allude to that the laws he quoted are also in the law. Yeah, everything he quoted are in the law. Like if you check the JTB document that he's talking about, most of the rates were just harmonized to just be in a simple document for both the federal and the state to be able to use one document to just, if you check the schedule to the Stamp Duties Act, it's very cumbersome to actually review and even spot out rates, even for many professionals. And very few professionals are able to read Stamp Duties Act very well, even to understand it. However, so like what I said, if you check with the harmonized rate, it's just I'm sure it's very few of them that probably the law says 2 kobo, 1 kobo, that probably were changed, which were the fixed rates. So from what it said, like I said, is all the laws he has quoted are correct. And I'm not sure we've done anything wrong in, if you check what we have on our portal, are mostly rates that ad valorem rates that are already in the law, so are not new rates. Thank you. That's my question.
All right, I think we'll just take the final question, and that'll be for Tony. Tony, somebody asks, do you think that Nigeria increases property rates or taxes for property in view of, do you think it's going to help development? They say already your profile and observe that you are very good with tax, property tax.
Okay, so it's best to have taxes set as a threshold above which most people can put a decent roof over their head, keep as much of their money in their pocket as possible, and put that towards their children's education. Taxes should only rise if the government can employ them properly for the benefit of the people. So it's about having the right thresholds at the right time for the right reason, and explaining that to the population in the way which they're broadly happy with. Start to lower the threshold at which tax is paid. If you start to increase the taxes unrealistically on realty, ultimately it has a negative effect all around. You know, people don't accumulate wealth, the government collects less money, and we all descend into chaos. So no is the short answer. You know, have a higher threshold before you pay tax, and only have a tax rate, you know, which is necessary, you know, to pay for reasonable expenditure and have a surplus. Does that cover it? Or was that too political?
Oh, sorry, I didn't know I was unmuted. Thank you very much, Tony.
My pleasure.
Yeah, we have other questions. We have 5 more minutes to go. Let me see, a whole lot of them. I'm just trying to choose the ones that are very pertinent. 1 second. To be qualified to be a company exempted from tax payment that makes below 25 million threshold, would a company have to be registered for VAT or CIT, assuming it's a new company? I don't know.
Can I take that?
Yes, please.
Okay. As I said during the presentation, the Finance Act has amended the time of the period of the duty to register for VAT. Under the Finance Act now, as soon as you commence business, and it cannot be determined at that point whether the provision of the Finance Act Section 38 modifying Section 15 that creates that threshold will arise. It can be determined at that point, because the law says you must first register as soon as you commence business. That's what you do first. Then it's later in the course of your business that it will be determinable whether you are supply either a single supply or cumulative supply for a year is up to the value of 25 million naira, which will bring you under the threshold where you will not be liable to charge, remit, and account for VAT. But as soon as you are commencing business, the duty to register for VAT arises. In the course of your business, then if your supplies in a year fall below the 25 million threshold, then duty of charging and remitting and accounting will not fall on you. But if it is 25 million or above, then you will be liable to charge and remit and account for that.
Okay, good. Thank you. Olufemi, this one is for you again. Okay. Femi, are you there?
I'm here.
Okay, someone said, why should I be charged stamp duty if I transfer from my account to my account in another bank, since both accounts belong to me? Is that not double charging? From my account in Bank A to my account in Bank B.
Unfortunately, that is the law. And so, like I said, FRS does not make the law. Our representative makes the law. So that's the law. The law only exempts within the same bank.
Well, I don't want to talk about fairness law in another, because since it's my since it's both accounts belong to me, you know. All right, that is one. Then two, another question for you. I mean, you are the one on the hot seat today. It's in a transfer of funds transaction between Adamu and Shegu. The relevant parties are Adamu and Shegu. Why should you assert that the bank is the main party, and so the bank and so the stamp duty should go to the federal government? Section 4, subsection 1 of Stamp Duty Act recognizes 2 parties and not 3. So the bank as an intermediary is not one of the 2 parties.
Okay. If you read section 89 very well, in fact, it does not even mention individuals in that section. It says where a money is deposited in a bank, and such is further, and where money is transferred from the bank. So if you go and read that section well, it does not even mention the individual. It's only talking about the transaction. And who carries out that transaction? As far as the law has only mentioned that party, which is the bank. Yes, we know that there are people who deposit money into the bank and people who receive such money from the bank. The transaction, everything is being done by the bank. So that is why. Also, let me go to the law. If you go to section 3.3 of the Stamp Duty Act, the law clearly provides that both the government of the federation and the government of a state shall have the power to collect duties under this act to the extent that they have power to make law over such person. So I'm very sure that the state government does not have power to make laws to collect duty from a company under the act. It is in the purview of the federal government because, in fact, the transaction one, the underlying transaction is with the bank. Number two, the instruments that will be issued, underlying instrument that will be issued in respect to those transactions is the bank that issues such instruments. So at the end of the day, the bank is a company, and the money goes to the government. The competent authority.
May I ask a question? Sorry, may I ask a question?
Okay.
Olumide here.
Yeah, go on, Olumide, go on. Ask a question.
Yes, Mr. Larinde.
Yes, sir.
So if I work for you, and you pays my salary to First Bank, what has First Bank got to do with my salary? Because even though I get a lot or I received and whatever. And secondly, I get if I work for a law firm, there has a branch in London and one in US and I'm here in Nigeria. And there's a document between the London branch and US branch. And I look at the document in Nigeria. Why should does that mean that document is chargeable to stamp duty in Nigeria? So those two questions, the bank is never in the first question, the bank is involved at all. It's just perfunctory, just peripheral. So
but sir,
it's not, the bank is not updated.
Your question is even more complicated because your question is only about from a company to an individual. So the company that you work for, the bank that transfers the money, they are all corporate. So there's no two individuals in this transaction. Except you're talking about cross-border transactions.
So if I collect salary from Unilab,
yes,
I collect salary from Unilab to the bank.
Yes,
so does the bank have the right to go to TAT to challenge anything on the salary?
If the bank has the right to go to TAT to challenge on the salary, are we talking in relation to duty now?
Let's say there's a problem. Let's say there's a no, no. I'm making the PITA is the same thing like the stamp duty. The only thing that connects the bank is the fact that my institution is paying my salary to the bank. So there's nothing involving the bank in the transaction at all.
Oh, Mr. Lumide,
the bank can never be an accused party.
I disagree with you. I'm sure if we go on this argument, we're going to waste the time of. I can still take you on this argument, maybe on the sideline, because the administration of the Personal Income Tax Act is different from the stamp duties. Number one, for Personal Income Tax Act.
We are out of time. We are out of time, please. We are out of time. You can take this question offline, please. We're really out of time. Olumide, somebody said, can you provide more clarification on NGO and payment of VAT? You just have 30 seconds to answer that. NGO and payment of VAT on transactions relating to their object clause.
Well, the only thing, the general answer to that is that under Part 3 of the first schedule, the NGO might be qualified for zero-rated treatment of their transactions. But if I would need more facts to be able to give you advise you properly. But the general answer I would say that they might qualify for zero-rated treatment.
All right, thank you. Thank you so much, all our panelists. It's been an exciting time. We've done 2.5 hours, 30 minutes, more than the time that we planned for this. I want to start by thanking Tony, all the way from UK. Tony, thank you so much. You brought an international insight and a different perspective to our discussion. Thank you so much, Tony. Okay. And we look forward to having you again on future sessions. I want to thank in a special way Dr. Mr. Olumide Bayami, a lecturer from University of Lagos. I want to thank especially the man that has been on the hot seat most, Olufemi Olarinde. I'm not surprised, but I think he discharged his obligation credibly. But not least, our own Dr. Jeroko. Thank you so much for the delivery.
You're welcome.
Guys, it seems like the technology is broken on as well. I'm going to go out at this stage, and thank you all for having me. For me, well done for being in the hot seat, old chap. Yeah. You did well. I'll catch up with you in due course, and the pepper steaks are on me next time I'm in the country.
Thank you.
Take care, guys. Take care.
Thank you.
Hello. Thank you so much. Thank you so much. I apologize about that technical hitch. But thank you so much, everybody. And let's do it again sometime soon. God bless you. Let's do it again sometime soon. God bless you.